What's going on, everyone? Welcome back to our Beginner's Luck series. My name is Kalen.
My name is Subi.
And today we're going to be talking about price versus value.
So here's the long and short of it. The movement of a stock's price has no impact on the value of the company.
As Warren Buffett would like to say,
price is what you pay and value is what you get.
I loved and hated everything about that. So in most ways, price is actually for traders, whereas value is for investors. Traders are looking for the price to move one way or another in a really short period of time, like we talked about in our last video. Whereas investors can buy into something and wait for a price discovery to occur, because they're usually buying in when the price is lower than the value of the company itself.
Thus making it a good investment.
Exactly. So what is this thing we call price?
The price of the stock is what you see on your screens. The simple way to put it is what you pay when you try to buy the company. The actual dollar amount or the cost per share to own a part of the company. For Apple, it'll be something like $165. For Tesla, it'll be somewhere around $800. And for something like Google, it'll be around $2,600. Given these stock prices, you would think that because Google, which has a cost per share of $2,600, that it'd be worth way more than every other stock that I just mentioned. But this isn't actually true. Google, which has a market cap of about $2 trillion, is worth a lot less than a company like Apple, which is around $3 trillion. But Apple is only worth a cost per share of $165. So it just goes to show you how psychological the actual price versus value of the company is. To that point, people think that Google, because of its high stock price, is very expensive. But the truth is that cheap versus expensive is solely in relation to the value of the company. This means that Google can be very cheap.
Alright, say it less foreign.
What?
Google.
Google. Google. Hire me. This means that Google can be... What's wrong with the way I say Google?
Bro, you've been saying it fine the whole time except for these two times.
This means that a company like Google can be cheap at $2,600 per share, whereas GE can be expensive at $95. These are so good. You want to try some?
I got my own bag, thanks though.
As we mentioned earlier, the price of a stock is a very psychological game. Price and value don't always match, so it's your job as an investor to understand this in order to minimize risk and to manage expectations to add to your portfolio. But how do we value companies?
Hey, me again. First off, the value of the company is what it's truly worth. So this could be defined in different ways, really based on the methodology used, but in general, it's using some level of fundamental analysis in order to assign a dollar amount that the company is truly worth. In general, in the professional world, this is known as a price target. The price target is based on the current stock price itself. So if the current stock price, the one that Subi was talking about, is below the price target, then it means that the company is undervalued. Whereas if the stock price is above the price target, then that means that the stock price is overvalued. So a couple popular methods in valuing a company are things like the PE ratio, which is the price to earnings ratio. Now this is the most popular one that you're going to hear in any type of TV show. But other ones is something like the price to book, which is very commonly used in banks and financial institutions, or even X times next year's EBITDA. EBITDA, by the way, is earnings before income tax, depreciation, and amortization. There's even other ones that are a little bit more complex, like different models that most professionals use, which are the dividend discount or the discount cash flow, both very popular. Now, this isn't anything that we're going to be getting into. However, anyone can learn how to do it. It just takes a little bit of time.
When you said EBITDA, I was like, Google.
EBITDA, that's how you say it, EBITDA. So there's two questions that you want to ask. The first one is, what is this company being valued at, i.e. the market cap, which you can find the definition of right here. Now this can be found a couple different places. One can be in your brokerage, which we'll show you an example of right here. And then the other can be on Google, which is a really easy one, and we'll show you an example of that right here. The second question you want to ask is, what does the current growth of this company actually look like? So a lot of times you take current numbers and you try to project them out into the future, mainly based on anywhere from a 3, 5, or even 10-year time horizon. But most often when we're creating something like a model, it's based on a 5-year time horizon. The answers that we're looking for these questions are, what does the revenue growth look like? Are we still growing at a really nice pace, and do we see that moving on in the future? Also, what kind of trends are we seeing in the world right now, and will this company even fit into it? And then the last and probably most important thing for any company is, what is the execution of the management team like? One of the more interesting and annoying things that Subi and I have talked about quite a bit is when you're learning how to value a company or even learning about how to talk to somebody about a company or a stock, they very often say past performance does not dictate future performance. Now that's very true. However, we also use past performance to try to decide future performance, which is a very interesting conundrum. Brings me into my next point, which is to talk a little bit more about the revenue growth. So, for example, if a company's been growing 10% year over year and you feel as though this trend is going to continue based on the forward guidance that they're giving in their quarterly earnings call, then that can be a good thing. You can even see that they have other products coming out on the horizon or are going to be doing things differently that could be increasing that revenue growth, profit growth, margin growth, all these various levels of growth that you want to see in order to invest in a company long term. The next big thing that I mentioned was the trends that are on the horizon, right? Now, of course, you guys have probably heard the example 100,000 times, but something like a Tesla. For Tesla, they work all on green energy and green cars, EVs. So if we see EVs becoming bigger and bigger in the future, something like Tesla, which is absolutely the most successful company in that space, could be a great investment where we could see their margins continuing to improve, their revenues continuing to improve, and of course, their profits continuing to improve. So that brings me right into our last point, which is the most important for the two factors to even be considered at all, which is management's execution. At the end of the day, we rely on the forward guidance of these management teams in quarterly calls and annual reports. However, if we find that they're consistently missing their objectives, then why should we ever believe anything that they're going to say in the future? Thus meaning that these investments aren't going to be a good idea based on the incompetence or potentially even selfish greed that the CEOs and boardrooms have. Answering these two questions provides a really great base and framework for you to work from when trying to shape your investment philosophy. Now, there's a lot of qualitative ways and quantitative ways to measure things, but at the end of the day, the two really come together. And as we mentioned a bunch of times, of course, psychology plays a major role even in value, as we all think of things differently and how we would value them. So let's get specific for a quick second. If Nvidia, per se, is trading at 30 times next year's revenue, and all the other companies in the microchip space are trading at 22 times, we have to try to understand why Nvidia is trading higher. Because a lot of times, companies can actually trade just based on their name and not necessarily on their results. We want to see if there's a better opportunity in that space, or if Nvidia is actually just the best one, and that's where we should be putting our money. So in this example, we see both qualitative and quantitative, and just the level of psychology that can actually go into these two things and how we determine the value of a company. It's the same way in price versus value, as they're both very relative to the person and in terms of how we like to think about these things. But the biggest question of all, of course, is why is this even important to your portfolio? Our first answer to this question is that understanding a company's value versus their stock price is going to really be imperative in trying to create returns over the long term.
And to kind of go deeper, as you mentioned earlier, some stocks are priced higher, but that doesn't mean they're always fairly valued.
Exactly. And look, the complexity of the various methods that we use can vary greatly. However, understanding even really simple things like the PE ratio, which you can find on most brokerages, we'll give you a quick little example right here, is super important when it comes to trying to value a company and give you a head start on trying to understand why a company is valued a certain way and whether it's even a good investment. And not just that, I'm going to throw one more quick thing in there, but it helps you understand when to invest in something, right? Because something may be a great company, but it's just the wrong time.
And to kind of piggyback off that, there's some really great websites out there that we'll try to link in the description. I just kind of can pop a few up here that can break down the company's stats so you can further kind of increase your knowledge of what to value for a company.
Right. Just get used to seeing things.
Exactly. Just so you can see the numbers and see why you might want to do something or why not, or why you don't want to do something.
Exactly. At the end of the day, once again, just like we mentioned so many times, our job as investors is to make money and grow our accounts.
Profitable.
Now, really the biggest thing is understanding the price versus the value of a stock is going to be huge in actually helping you to do this.
Right, so you want to get a lot of bang for your buck. You want to be able to use your limited funds because a lot of times new investors don't have a huge amount of money to work with.
Right.
And they're very nervous with the amount of money they already have in. So if you have any amount of money, you want to be able to really put it in the best possible spot. And that means that you have to make sure you understand the actual price versus the value of a company.
Right, and to come back to that psychology, you want to feel good about it. Because when you feel good about when you invest and what you invest in, it's going to be much easier for you to stick through if there are any hard times.
Right. You got at the end of the day, you also have to believe in the company you're investing in, right?
Absolutely.
And so if that increases your belief system, if that makes you understand why Apple or Tesla or whatever the heck it may be, if that makes you believe in them, then so be it.
Right. And taking just emotions out of the decision, right? When you have that belief, when you have all the various things that we've talked about, you're able to take the emotion out of it and understand that you looked into this, you understand this, you know you made a good investment, and you're not worried about it.
And you have some stats to kind of back you up as well.
Absolutely.
Which is awesome to have.
Absolutely. And the biggest thing is that all of this that we've mentioned, pretty much everything we mentioned in this video, is going to help you over the long term. Because those short little swings that we see are no big deal. We want to be up 2, 3, 4, 500% over a couple years' time.
So, this brings us to the end of the video for the day. Tune in next week. We're going to be releasing our first video for our next series called Bridging the Gap.
Yep, just for a little bit more of, the intermediate investor, the investor who may kind of see these and say, hey, I know these things, all right, let's move on to the next level.
If this is too freaking easy for you, don't worry. We're going to talk about something that it's probably a lot of people's minds, which is going to be inflation.
Yep.
That's our first video for the day.
Yep.
And
inflation, stagflation, and deflation. So if you don't know what some of those are, please tune in, because you may actually learn a couple things, and we'd love to help.
And as always, guys, thank you for watching.
Take care.